We now continue with more of the Mark Milton Show with the Smash.
I salute you on being able to go from the urban sector to down on the farm, man. Not too many people could do that, but Mark Milton gets it accomplished. Let me ask a quick question.
Sure.
When you work on the farm, did you wear overalls?
I did not. It was, it was kind of, gym shorts, T-shirt type of deal.
When you were following the St. Lunatics in your younger days, did you wear your Air Force Ones?
I was trying to think about that. I don't think I did have a pair. I've had various. For me, so I have a size. Really, I used to wear size 15s. I can fit into some 14s. So I was always a big Zappos guy. I would just go on and buy whatever sneakers I could get. So right now, I play a little bit of basketball, and I've got this pair of their Nike Flights, really unattractive, all black. Just really for utility, not for appearance. So.
My son, when he was 15, had a size 18 shoe, and you couldn't find any fittings anywhere. I was working in Washington, D.C., worked for the Washington Bullets, was the name of the basketball team.
Oh, yeah. I was former season ticket holder.
Really?
Washington Wizards here.
The Wizards, that's right. But I had a friend through the Bullets who worked for the Celtics. And I told him, I said, nah, my son, I can't find any shoes to fit my son. And he said, don't worry about it. So he sent me 4 pair of size 18s from the Boston Celtics, and the kid wore green shoes for about the next 3 years.
That's awesome.
But that's the only place you could find big shoes back then. Nowadays, you got them,
Yeah, I don't even, before we had Zappos or online shopping, I don't know what people did to get, extra size.
Oshkosh bagosh, that was it, man, because I weighed about 350 pounds back then. Mm-hmm. And that's the only clothes you could wear was farmers' clothes because they were made big because people were farming. I guess you need loose clothing.
Yeah, well, that's what I would just show up: gym shorts, T-shirt. In the summers, working, I would deadhead geraniums. I don't know if you're familiar with deadheading plants.
I'm not a big flower guy like you are.
Deadhead. Well, I'm not really. But
you said earlier with Al that you're a flower guy.
I learned how to deadhead a plant.
You love the chrysanthemums,
the mums, yes. But you would have to basically pick off the dead flowers so that when you pick them off,
it's called deadheading.
Deadheading, so the new ones will bloom. They keep regenerating.
Well, sure. Yeah, it's almost like pruning the vine.
But it would be like 110 degrees in those greenhouses. Yeah, in the summertime in St. Louis. So,
wow,
but it was
how
a lot of
thin
fun.
were you then, man?
I was much thinner.
Yeah, the greenhouse effect.
Yeah, I was much thinner. Yeah. Definitely several pounds ago, but a lot of fun. And also, I love Soulard Market. If you haven't had a chance to get down there. A lot of fun, great prices, great selection, not only at the Sharf stand, but at all the local vendors there. So, well, what are we going to talk about now? Taxes. We were going to talk about taxes.
Oh, you are the St. Louis tax lawyer, right? STLtaxlawyer.com.
Right, and remember, the choice of a lawyer is an important decision.
Well, of course it is.
Should not be based solely on advertisements.
Never.
But what I want to talk about today is retirement. For many people, the last few months have taken a toll on 401ks, IRAs, but the market is starting to recover. We're getting back to a point where, this week it got above 25,000 again for the first time since this all started. And so for people out there who are looking to save on taxes both now and in the future, it's important to understand the different vehicles available to do that. Most employers, big employers may offer a 401k. What a 401k does is it allows sort of pre-tax deductions, money to go into a retirement account, and you save taxes on the current year versus, and it's similar to a traditional IRA in that sense. If your employer does not offer a 401k, then you're able to contribute to a traditional IRA up to, I think it's $6,000 for 2020, and then you're reducing your taxable income that year by $6,000. The catch is, the money grows tax-free, but when you take it out, and there are something called the required minimum distribution, once you hit a certain age, you are required to take the money out. You do get taxed on that income as you take it out of the account.
You get taxed heavier than you would have originally?
Well, that's a good question. So you get taxed at your then current ordinary income rates, right? So if you kind of got to think about, well, if let's say I'm making $100,000 now, I'm in a certain tax rate. If when I retire, maybe I don't have that much in annual income, and so at that point your tax rate's going to be theoretically lower, assuming tax rates stay the same. And that's why I want to talk about the Roth IRA, because the Roth IRA is you're putting post-tax money into it, and that means you're not getting a tax benefit now. You're not getting a write-off from putting money into the Roth IRA.
Yeah.
But what you do get is you get, the earnings grow tax-free, and when you take it out at some point in retirement, you don't pay tax on it at that point either.
Nice.
So to the extent you can put money into a Roth IRA, because there are income limits in terms of who can put money into a Roth IRA, and we can talk about Roth backdoor Roth IRAs, or Roth conversions as they're known, is another thing to consider. But really, I think it's, in a way, it's good to have a mix. So if you've got an employer who's offering you, let's say, a 3% or a 5% match on money you put into your 401k, then I think you should take advantage of that match because it's basically free money. And so the money you put in is going to be tax deferred. But if you can put money into a Roth, then I think it's also a really good idea, especially right now, because with the tax cuts that went into effect in 2018, and on top of the fact that we've got all the spending going on by the government, I don't believe that individual tax rates will ever be lower than they are right now. So from that standpoint, you want to think about, well, if they're never going to be lower, then it might make sense to just go ahead and pay tax on my income now, put my money into a Roth IRA, let it grow for 30 years.
Right.
That way, when, Bernie Sanders Jr. is elected president or whoever it may be in 40 years, and they're talking about a 60, 70%, top income tax rate, then you're going to be getting that money out tax-free, whereas if you're taking money out of your 401k or your IRA at that point, you're paying, theoretically higher tax. Question, Mr.
Yes,
Ben-Ruby.
If you are of an age that puts you into the geriatric group, is it too late to get a Roth IRA? For example, let me use me as an example. I'm not saying I'm the example, but let me use me as, I'm 70, all right? Is it too late for me to use an IRA? Because I lost all my IRAs in my travesty of unfortunateness.
Well, so when you're younger geriatric, I'd say 55, or there's certain ages where you can put money in at a bigger, you can put more money in to help you save for retirement. Unfortunately, when you get to be in your 70s, then you're faced with, well, I can put money in potentially, but then I also have to take. No.
You're faced with, I'm going to die tomorrow. So how am I going to save any Roth IRA
But I
money?
think it does present.
Go ahead and say it, Mark.
Well, it depends. I hate to give the lawyerly answer, but it sort of depends. But I will say, once you hit a certain age, 70 and a half or whatever the current age is for a required minimum distribution, then you're going to have to, you'd basically be putting money in to just take it right back out.
Yeah.
I mean, that's potentially what you'd be doing. And I don't, that again, we could talk about that.
But for the youngers,
but for the younger people,
thing.
If you're younger, let's say you're nearing retirement age, which for most people, people look at late 60s, early 70s as retirement. And let's say you're in your 50s now, you definitely want to look at, and you're maybe in your peak earning years, right? If you're in your 50s or even late 40s. I mean, for most people that aren't professional athletes, those are your peak, income years. So you want to look at, if you haven't been putting money away for retirement, you want to consider, all right, what can I put away? Are there acceleration amounts that I can put away to help sock money away for retirement? Another thing I would recommend to people when you're talking about sort of retirement, long-term planning, the health savings account is a really good tool, especially for younger, maybe healthier taxpayers who, maybe you're in your late 30s, early 40s. You've kind of gotten out of the, having children phase. And so you have the ability with the HSA to sock away $7,000 a year. That's the current limit this year, tax-free. And it gets put into an account that can grow. And again, it grows tax-free. And as long as you take the money out for a qualified medical expense, let's say you're in your 70s and you go to a nursing home, or you have excessive medical bills, you can use that money to pay those medical bills and not be subject to tax on the distributions. So that's something. The catch there is you have to be signed up for a high deductible health plan. So if you are someone that you may have regular prescriptions, or you're frequently incurring medical expenses, the high deductible health plan may not be for you. But again, if you're talking about relatively healthy and you're looking to save on taxes, the HSA, the health savings account, can be a really, really good tool for doing that.
I'm just thinking, when I do pass, I would like you to be at my funeral, and
I will be there, Smash. Assuming I don't predate you.
Well, good point.
Hopefully I was going to say, hopefully I don't
predate
I
you.
hope I don't die before you. That's like kind of a harsh thing to say,
Yeah.
but
I don't
will
know if I
say,
have the time to get to yours, but hey,
you
I'll
got
look forward
36 years on me,
Yes.
right? So I do hope that I outlive you. I'll just be honest
Well,
with
yeah.
you.
I hope that, you maybe come up and make a statement. Don't
Sure.
talk about what a wonderful guy I am.
No, I would love to.
Tell people about the Roth IRA so that they will know, so that they will not have the perplexion that I, Sir Smashington, have here at this particular point in my life.
No, and that's something that one of the things, I do tax resolutions, so people with tax problems, I help, but I also enjoy the tax preparation, the tax planning side and I love working with individuals because, I think one of the things that we lack in this country is financial literacy. I don't think we do a good enough job of
We don't.
teaching kids,
That's right.
young adults, sort of things like what we're talking about right now. How do you save for retirement? What is the time value of money? When you put money into an account, it can grow at 4, 6, 8% a year, and the benefit of interest over time, and just all those things that I really started to learn in college. In terms of taking finance and accounting courses. But these are things we should really be teaching in junior high
I would
school.
think so.
Debt, credit.
Yeah.
I mean, all those things where can be very damaging to people and really haunt them for most of their life.
Yep.
Because they don't have a good understanding at a younger age.
Yeah.
And then, like I said earlier, when you talk about earning potential, like most people kind of stumble through their teens, their 20s, and then in their 30s and 40s is when they really start to, make probably the most money they're going to make in their lives. And if we did more, I think at a younger age to teach people about financial literacy and investing and things like that, then those people would be so much more well-positioned to be personally responsible and to build their own, wealth and retirement plan, and not have to depend on the government, not have to rely solely on Social Security. Because to be frank, when I look at my own, retirement, well, I don't really ever plan to retire. I always tell my wife that. I enjoy working. I like, doing things, but I obviously would want to take a step back at some point, play more golf, do those things. Yeah. And I look at it like, hey, I want to make sure that, the money's there to have the financial freedom to sort of be able to do those things. And I don't want to rely on the government. I don't want to depend on Social Security because I don't even believe Social Security is necessarily viable, for all the reasons that come around every election year. Oh, there's not enough money, because there really isn't. So anyway, I'm getting on a soapbox there, but I think this is all good information for people just to understand what their options are as far as retirement savings, health savings accounts, and how that can benefit them from a tax standpoint.
Always good information from you. Real quick, as we close up here, after I die, can I use my grave plot and my tombstone as a tax write-off?
So generally, if you're talking about funeral expenses and things like that, that generally would not be deductible. So what happens is after you pass away, you have to file a last tax return. So if you passed away and say
somebody's got to file a tax return for me?
Yes, you're
what
required
kind of country is this?
And there would not be a mechanism to deduct that on your personal tax. But you wouldn't care at that point. I mean,
I'm gone,
so it doesn't really matter.
I'm thinking of the Ben Rubies to follow.
Well, and this has been a great show. I just want to tell people, if you're enjoying what you're hearing, subscribe to our podcast. If you have questions that you want answered, we can try to do that on the show. Just email me at mark.milton@stltaxlawyer.com. Again, that's mark.milton@stltaxlawyer.com.
And that is it. That is Mark Milton. Smash with you right here. The Mark Milton Show.